Welcome to another episode of the Road to Wealth podcast. I'm here with a honestly distinguished, honestly has a reputation that holds its own weight, one of one in terms of the attorney space for syndications. And I would definitely love for you guys' time and attention to be spent listening and learning at a very high level with Mr. Tilden Moschetti. Hopefully I pronounced that right. And let's get right into it.
Great. Well,
So
thanks for having me on your show.
thank you so much for even, gracing us with your presence. I want to ask and kind of get right into it. What did your beginning look like? How did you know this was something you wanted to specialize in?
I didn't. I kind of did, but I kind of didn't. So I didn't know really about syndication much at all. Before law school, I knew I wanted to be a developer. That was sort of my goal. I came up with a whole plan about how to build assisted living facilities, and I was going to use manufactured housing as a way to do it on a on a lower budget, and it seemed like a great idea and probably still is. But so I knew I wanted to be a developer, didn't know how I was going to raise the funds. So I looked around and looked at other people who were successful at putting together these sort of things. And a lot of the people who were there were attorneys. And so I thought, okay, well, that makes sense. You learn about the law, you learn about how to get a deal done. I should go to law school so I could, increase my chops. And so I did, and really focused mostly on real estate and property law and
Hmm.
contracts and those sort of things. But still found myself ended up as a litigator. So I was a litigator for about 10 years. Um, and I specialized in real estate disputes. So not your landlord tenant stuff, but what I did was if there was property underneath it, whether it was valuation or something like that, as related to partnership disputes or divorce or bankruptcy or anything like that, those are the kind of deals I did. It was miserable. Litigation is not fun for anyone. Uh, and I had started doing just some brokerage just to kind of make things a little bit more palatable and kind of even out the money flow. And one of my partners came to me and showed me a deal, and he said, well, yo, this is a really great deal. We should syndicate it. And I looked at it, and it was a good deal. And I thought, okay, we can syndicate this. And I had no idea what that meant. So I learned on that deal. I figured I was a lawyer, I could figure it out, and it was
Hmm.
challenging. So that deal was successful. And then I did another one and another one. And as they came together, I got really good at it, at putting deals together. And thought, I should change my practice area, not practice litigation anymore. And so about 10 years ago, I stopped litigating and started just helping syndicators and fund managers put together these deals and help them understand how to raise capital, and we went from there.
That is phenomenal. If you could break down that first deal and what it looked like for you, maybe like how many units, do you remember kind of like how much it cash flowed?
I don't remember that. It was a while ago. It was a medical office triple net building in Alabama. It was being developed at the time, and so I was able to buy it at a good cap rate because there was still some risk on whether the development was going to be successful and things like that. And also, it had a nice time horizon, which was great. It was off market. Um, the price was around three and a half. I think three and a half. And then uh, raised just over 2 million for it. Had probably about 20 investors.
Mm.
That between me and my partner, we brought in mostly people we knew, and kind of held the deal that way. Held it for maybe 3 or 4 years. Um, was a good property. The market looked good, and ended up selling it. So got investors their money back. It was good.
Now, in that too, as you mentioned that you raised $2 million, what is something that you noticed when raising money that people ideally should be mindful of, or can be, or need to be mindful of?
Sure. Well, I think what's most mindful is what I call the founder investment theory. So that came out of this deal. So the first time I pitched this deal was to a doctor, had lunch with him, and told me this deal just wasn't for him. So this was my first rejection, my first pitch, and learned a valuable lesson from that. In that it's not only at the end of the day, investors aren't just looking at what the IRR is going to be or what the preferred returns are. It's easy to think that they are, because if you look at ads on LinkedIn or Facebook or something
Mm-hmm.
like that, that's all you see is those numbers and as bullet points. In my experience, they don't, that's just not that, that's not the main mover. What really moves is not only does it fit in with what they think as a good opportunity. So is the risk profile match what they are interested in? Is the situation similar enough to something that they've done that they'd feel comfortable doing it? But at the end of the day, also that story. So why is this a good deal? Because if they don't understand that story behind it, then they're just not going to invest. There are plenty of other deals. I mean, maybe this one has a 2 points better in the IRR, but the IRR is a projection anyway. So why should they trust this and go for this rather than something else? So it's that founder investment theory that I think is the most important thing that's missed.
And you said the founder investment theory.
Yeah, it was just a
Okay.
phrase I came up with
I like
really
it
to
though.
describe that. Yeah.
Hmm. I think one of the things that I've even noticed, when dealing with clients is like, do they actually understand why they are looking to make this purchase? Like, is it important for
Yeah.
them? Because while I can
Yeah.
consult them and say, hey, you need to, this is a unicorn. They're like, I got this bill or I got to pay off this debt. And it's like,
Totally.
so I think that that's something I've also noticed. Do you feel as if that, what would you say are some of the fears you see people kind of, I guess, internalize in terms of investing in a syndication?
Well, I think that there is, I mean, the number one thing that anybody who's interested in investing has to have, they have to trust the guy. They have to trust who they're investing with.
Very
So
good.
once you overcome the trust hurdle, it gets a lot easier. Um, if you don't know this person, if you never had any dealings with them, it's going to be really hard to convert them to an investor, even if it's a great deal. Just because there's other deals where they probably could find more trust out there if you haven't built that up. So I think trust generally overcomes most of them. I think another kind of roadblock is they just haven't heard of this before. So a lot of people think, well, we can just, you know, my brother-in-law did a syndication and we just all put in money. Why is there all this paperwork involved? Well, the fact of the matter is you need all the paperwork that we do, but there's also this kind of this insecurity about, well, what is it exactly that we're actually giving money for, and how can I hold that syndicator as responsible, to give me my money back at the end of the day?
Right. And I think that's something that may be, of course, based off of the structure of the deal and maybe when are they giving profits out or returns, is that monthly or quarterly, maybe even yearly. I think that, you know, I like what you said when you mentioned about trust, because it's like, if somebody doesn't even have some embedded trust within the deal or within the person that they're looking to do business with, how can you expect them to just give you money? I think that's
Yeah,
something that's
yeah,
very,
no one
very,
will.
yeah, no one will. So, so you mentioned something too, that in the first deal that you did, there was 20, like, essentially investors. Do you feel as if that's too many, or did you feel like based off that first deal, it is what it is?
It was okay. I didn't want to do a raise where I was over asking. I was, it was the first deal, so I didn't want to, most investors were at $50,000. I didn't really want to ask for 100 or 200,000. Um,
Hmm.
it was uncomfortable because I hadn't done it before, and so getting myself over my own fear hurdles was a challenge. Um, and getting good at talking about, essentially you're selling. So getting good at the sales process and pitching the product was a hurdle for certainly for us to overcome. I think 20 is fine though in terms of a number. Um, uh, I think it becomes way too many once it's like over 50, and certainly if you haven't done one before, now 50 wouldn't be a big deal.
Hmm.
Because I know what investors are looking for. I mean,
Right.
the reason why it gets lopsided or why more investors isn't necessarily better is because you need to communicate, right? So unless you really know what you need to communicate to them and really help them know what it is, you might have more phone calls, and phone calls are fine. But when you have too many of them, it can become a little bit challenging to just field them and answer them right. It's also just hard to bring the money in when you've got 50 people that you're all trying to,
Right.
coordinate everybody all at once.
Hmm. Now, how do people go about finding the money? Because one of the limiting beliefs.
Yeah.
No, I've seen like just one
Oh,
of
yeah.
the limiting beliefs is that a lot of people say investing, yes, I want to invest, but it's just so hard to find the money. And it's like, and then on the other end, you hear, well, go get the deal first and then go look for the money. So I think like
Yeah.
based off of your experience, which one do you, kind of cater
Both
towards
at
or
the same time. I mean, you're always looking. I mean, as a syndicator, you were always looking for investors. You're always looking for deals. It never stops.
hmm
Um, because the best deal may be the one you haven't heard about yet, and more investors is good, right? So it will make your job easier in the future. So I think you're always kind of doing them both at the same time, and when that right deal comes along, or at least the right like founder investment theory, then that's when you start putting a deal together. Yeah, I know what my next deal is, but I don't know at this point, but I don't know the property, but I know where I'm going to get it. I mean, I know how I'm going to source it, so it's not really much of a challenge. But it's still more okay. Well, how am I going to get these investors, and how am I going to talk to them about this and this opportunity so that they're interested in coming in the first place?
So it's kind of like it's, of course, citing or sourcing the opportunity. And then you're always, it said, looking for investors. So then by the time you do look to pitch, it's kind of like, hey, this is something we've already talked about, or this is something that
Yeah.
I've been working on for X amount of months. Okay. Okay, that makes
Yeah, I may
sense.
not be explicitly saying, "Hey, are you interested in investing in XYZ?" But I'm always talking to people. I'm always improving my visibility and looking at so that way more and more people are in my network. That when it's time for that raise, it's like, okay, so here's the deal. We talked about me being a syndicator. Here's what I'm working on. Is this something you'd be interested in?
Mm, okay. Okay. And then in doing so, is that something that you look to put in writing or it's just an honest conversation?
No, it's not enforceable in writing. I mean, it's well if you get it in writing only to the extent that people are more willing to follow through. If like they send an email that said, "Yeah, I'd be willing to invest," maybe they're 10% more likely to follow through.
Hmm.
Uh, but you'd never. I mean, even if it was binding contract, you'd never sue them on it. You'd never get that investor again ever in your life. So
Right. Right. I know I see that. So it's like, don't look to screw the person over just because,
yeah,
or it just, I see what you're saying. So it's kind of like it's just an honest conversation to say, hey, here's this opportunity that I've been thinking about.
yeah.
Is this something you're willing to invest into or know anyone else who is?
Yeah, exactly. I mean, you're always just trying to you need to know who your investor pool is. I have a pretty good sense of who I've got, and okay, well, I know these kind of returns are probably right, but it's got to be, in my case, the next deal is not cash flowing. It won't cash flow at all. So I don't want the person who's going to be relying on cash flow, but I
Mm,
need to know, are they in this pool or are they not? And so if they're just purely cash flow people, I'm not even going to bother talking to them about that specific deal because it's going to erode their trust in me. They're going to
right,
say, well, we told you we only want cash flow deals. Why are you showing me this?
right,
You're
right.
right to question it. So
Yes. So what's the alternative? So if it's not a cash flowing deal, are you more so talking about you're banking on the appreciation of the said
yeah, it'll
property
be
or
a pure appreciation play.
okay. Okay, which I think that's very solid too. So, in terms of actually looking to then raise money, what are some things that you would tell someone to set up their LLC in such a way where it's able to then raise the capital, if that's something that you're
Sure.
able to get into?
Yeah, absolutely. So kind of over the surface of all of this is our security rules. So there's
Yes.
a common misconception that you can borrow money or you can have a limited number of friends and family. Or today I heard a new one on me as if you're only raising 1.2 million, you don't have to get paperwork. That one was new to me. The reality is if you're raising a dollar from anybody who is taking a passive role, it's a security. And as a security, that means that it either needs to be registered, which nobody here is going to do. Registered means you're going public. You're going to hire about 50 lawyers and you're going to spend, $1 million putting together this deal with Sachs for that, or Sachs, with Goldman Sachs as your underwriter, right? That's
Mm-hmm.
totally different animal. We're
Mm-hmm.
talking about, so we fall under the exemptions. So not everything needs to be registered. So the biggest exemption of all is Regulation D, which allows allows syndicators to raise an unlimited amount of money from an unlimited amount of accredited investors, and either have the ability to raise from non-accredited investors, or they can advertise. So it's a one or the other thing. But at the end of the day, there always can be accredited investors. It's just whether or not we have those non-accredited investors versus being able to advertise. Um, so that's kind of the very high level view of the regulatory framework that's there.
Mm-hmm.
So new syndicators, what they need to kind of understand is there's no problem in doing this. I mean, the advantage of having such a good rule as Regulation D is the SEC basically tells you exactly what you need to do to be in compliance. Uh,
Right.
and it's kind of like a welcome guidebook. You need to communicate with your investors. These are the things you need to tell them before they invest. You can have this many non-accredited investors and just do this.
Mm-hmm.
That's great. So once the new syndicator recognizes, okay, this is the framework we're working with, then it just becomes, okay, plugging the deal in, making sure it's in the right format that makes sense. And then it's working within that framework of, getting investors the information they need, eventually getting their money so that you can put it into the investment.
Hmm. So in terms of even the structure, is that also something you would then look to put people on as far as the not the structure of the LLC, but kind of like in that certain deal, or that's where the documentation comes in and why you have their attorney?
Yeah. Yeah, so a lot of times my clients will have like an idea about the way that primarily that money is going to be distributed in the deal. So we'll form the LLCs that are necessary if that's what we're doing. We'll put together the operating documents, the security documents that need to be there. And then as we're understanding the deal, as we're discussing it, I'll make suggestions about, oh, well, your fee structure here looks a little lean. You probably could make more. Or this looks kind of like you're taking a little too much. I think maybe you want to think about it taking less. I mean, at the end of the day, it's the syndicator's decision.
Hmm.
But I see a lot of deals. So I'm always kind of helping as much as I can say this is where market is. you can be above market. And if you've got a ton of trust, great, you can charge more than the market. If you don't have that ton of trust, you probably should be at market.
Hmm. Okay. This is very solid. This is very solid because I think that it's like a lot of, I won't say a lot of people, but I think it's so easy to then look to have a limiting belief around doing a syndication when really is like, you know, how do we position ourselves in such a way we're able to make a decision? Or if you say that this is a wealth building strategy, what information are you missing to then, be able to invest at such a high level? Would you say that for someone's first deal, they should maybe look to start out at 1 million, 2 million, or is it based off what their risk tolerance is?
I don't think that part is about risk tolerance. It's about finding the right deal. I think $1 million is kind of like a sweet spot like the low end of the sweet spot, right? So
Right.
it's raising 1 million isn't as challenging as raising 5 million. So it's a little bit easier on that, and the money's still good enough that the syndicator should be able to make money to more than pay for the work that they put in to to put it together in the first place. So I think that once you meet that 1 million threshold, you're certainly going to be successful at it. Then it's just a matter of making sure that the deal is presented right and that everything is right so that you do get the investors at the end of the day.
And so, what are maybe some of the things you look to pay attention to in terms of assessing if the deal is a good deal or
I don't know. So
not?
that's
No, I
that.
get it. I know like sometimes we talk about like location, but I mean like,
Sure.
like is it certain nuances or is it like I guess you could say the type of
Yeah.
the class the building is in? Like, does it just depend on, you know?
Yeah, that's not so important to me. I think it's I mean, certainly location matters, the demographics matters. I don't want to be in a location where the population growth is going down, right? That's kind of
Right.
like a major criteria of mine. I'm not going to go into a shrinking city. It's I'm just not. I'll go to where there's growth happening, and that's always what I look for first. So I kind of keep track of where those growth areas are. And then it's got to be something that has returns that are going to match what my investors are looking for. I mean, I have a group of investors that probably need about a 15% IRR. I have a group of investors that probably need a 20 plus, and they're slightly different, what each group needs. So it needs to fit into one of those. And then it needs to fit in kind of with the criteria of how I see deals. If I can't make sense of it, it's not going to work. If it's something totally not something that it doesn't particularly matter if I haven't done the asset type or whatever before. But if I don't have a plan for doing the hard things, like if I was going to buy like a 20 unit apartment building, well, I don't really want to be a property manager. I mean, that's personally what
Right.
I don't want to do.
Hmm.
A lot of people do, and they make great money at it, and that's great. But me, it's just not. I would rather pay somebody, you know, in order to do it, because I don't want the phone calls or any of it. And so, if if it was that criteria, if I don't have an answer who can be the property manager and maybe a backup of that person, I probably don't want to do that deal. Or if I know it's a development deal and I don't have like engineering on board, or I don't have something like serious about how I'm going to actually get the job done, I probably don't am not that interested in that deal. Um, the harder deals are generally just kind of because they just fall outside of that wheelhouse, and if you don't have somebody who can help you with it, then it's probably not going to work out at the end of the day. That's kind of how I look at it. Uh,
Right. Right. So I think that so what I'm hearing is that be very intentional with the type of deal that you're looking for
yeah.
and focus on the activities that will net you the most money.
Yeah, totally. And I
Yeah,
mean, you got to kind of get it. I mean,
right.
apartments are great because almost everybody's lived in an apartment before. So everybody kind of gets what's going on. Retail's good, but it's harder, right? Because there's more nuances in the lease structure and things like that. And unless you've been like a shop owner or you've dealt with the retail leases before, it may not make as much sense. Just because you probably haven't done a retail lease before, unless you've been in that world. Um, so you'd want to make sure that somebody at least as part of your team that you can bounce ideas off of about when things happen. Um, you can have tenants go out. You can, especially like franchise tenants, their franchises are set up in a very specific way, and you got to understand what the franchisor needs, what the franchisee needs, and
Hmm.
those all kind of need to go into it. And so, a good deal has somebody, and if it's an investor, they need to make sure that the syndicator knows what those things are. And if it's the syndicator, they need to be able to know it themselves, or they have good resources to be able to pull that from.
Got it. Got it. That makes a lot of sense. That makes a lot of sense. What would you say are the certain laws? I know we touched on it a little bit, but what would you say are certain laws diving into actually Regulation D that syndicators need to know about?
Don't touch money until you've got until you've given them the right document. Uh,
Hmm.
you don't want that. So I mean, investors should be getting a PPM, a private placement memorandum, which defines all of the risks of the investment, the terms, conflicts of interest, all those things.
Hmm.
That should be given to them. Uh, they need in kind of the operating agreement to understand the investment structure, and ultimately they need a subscription agreement in order to bind themselves to that operating agreement. Say, in exchange for this $100,000, I'm getting 10% of this deal. Um, and so without those in place, that's a big problem. Um, they Syndicators should know kind of how they're going to raise money, what that strategy is going to look like, because if their thought is, well, I'm just going to pay somebody a finder fee, well, that's not going to work either, because you're not allowed to pay finder fees unless they are licensed broker dealer with a Series 7 or a Series 22. I can't give that money to my buddy. I can't give him 10% of every dollar he brings in. And I think not everybody realizes that's an issue. So that won't get the deal done.
Right.
Uh, so those are kind of the most important, like high level laws as it relates to it. Um,
Don't
the
touch
rest of
money.
it is, yeah,
Yeah, yeah.
don't touch money and make sure you're either bringing in the money yourself. You're not paying people for that money. So,
Got it. So I think and then you're saying that that of course needs to be signed or understood before any money is actually wired, then is what you're saying. Or
exactly.
yeah, that makes sense.
They
That makes
should sign
sense.
the subscription agreement long before they send you the money.
Got it. Got it. Got it. Now, with that too, in terms of dealing with these investors, is this because I remember that you said that you just went to people that, of course, almost like know, liked, and trust you. So how would you then look to raise capital if somebody says, I don't have a circle or nobody, nobody at this point in time trusts me or likes me? How can I make money or how can I get money?
Why
What do
does no
I, what do I need to do? I'm stranded. I need to raise $1 million for this $4 million deal, but nobody likes me. So how do I go get the money?
well, you're probably going to be doing it under Rule 506C, which lets you advertise, so it lets you solicit. And
Hmm.
the strategy is going to probably it will either be like a straight advertisement, like something like on Facebook or LinkedIn. People are doing that very successfully, and there are marketers out there whose whole job is to help people, make those connections between people, basically seeing ads.
Hmm.
They do a good job. The other part of it is because a lot of broker dealers really aren't playing in this space at the, under $20 million level.
Right.
There's the fees just aren't in it for them, and so they pretty much can't economically uh, be in this sport. So it's either paying a marketing team that will do that. They're not taking money like on a performance. They're getting paid by, basically a flat fee or by an hourly or something like that.
Hmm.
Or you're going to be looking at strategies in order to grow that sphere of influence that you have. And like I like if it's a kind of a local deal where it's a
Hmm.
local building and the investors are likely local, I'll probably do an event that's local and probably cold call high net worth, high income people in order to bring people to that event. Partner with people to help bring them to the event.
That's very smart.
Um, if it's more on a national level, I might do it with webinars, but still I've got to drive people to that webinar somehow, and that's
Hmm.
I don't find the email lists very helpful, but it's probably going to be some form of like me putting together an advertising in order to find people who would want to attend the webinar. They're just these people are very low on the trust scale yet. They
Right.
don't know me at all, so I don't want to spend a lot of money per visitor because then you'll just spend a lot of money and never be successful.
Right. Would you prefer someone doing more so like that public advertising kind of like way of raising money, or do it privately just based off of the structure of the deal?
As an attorney, I don't whatever.
Yeah.
It doesn't particularly matter to me. I kind of it really is entirely from my where those investors are coming from. My
Hmm.
next deal probably isn't even from my existing investors, so I'll probably advertise. Um, there are some legal advantages to using Rule 506C over 506B that are they're kind of nuanced, but they protect the sponsor just slightly better. Not that anybody's really particularly vulnerable as long as they're doing the right thing anyway, then lawsuits aren't an everyday occurrence by any means. They're not they're pretty rare as long as everybody's you know being very good, which most of the time is the situation. Oh, you
My
went on.
fault. Yeah, my fault. And also in raising the funds, what would you say is the best type of entity to set up? I know we hear a lot about S corps or LLCs, or if it's
Sure.
whether it's sole proprietor.
It's almost always an LLC in real
Hmm.
estate. So if it's real estate, 99.9% of the time it's going to be an LLC. LLCs have straight pass-throughs of all of the tax benefits. So it's very easy to take advantage of depreciation for the sponsors, for the investors. It's all very straightforward. The liability protection is there for the sponsors, which it's not available under a limited partnership or a sole proprietor for that matter. And it's S corps typically aren't tax advantaged uh, for real estate at all. So for if it's a small business, maybe as long as it's not going to be, a huge number of investors because there's caps at the number of investors for an S corp.
Okay. Okay. So you would kind of say, well, if you're gonna just based off of what you're going to do, and it's especially being real estate, just get the LLC.
It's almost always going to be an LLC.
Now would now would it matter what state the LLC is incorporated in?
Kind of. So, I mean, the state at the end of the day is going to get the money if the work's being done there.
Hmm.
So, like, before I moved, 2 years ago, I was in California, which is a high tax state. So, if I did a deal in California and the property was just in California, well, I'm probably just going to set up in California anyway, because California is going to get the taxes no matter what. If the property was in, Texas, I probably wouldn't set it up in California, because why would I want to subject my investors uh, to paying California taxes when they don't have to,
Right,
flowing through the
right,
business? Doesn't make any sense. So it's more a strategic thing, just of, for the investment entity, the one that the investors go into, it's probably going to be where the property is. Or if it's a fund, it's probably going to be in like Delaware or Wyoming. As long as it's going to be the properties will be in different states. For the sponsor entity, it's probably more often than not the state where all the partners are in, and if there's diversity there, then it's probably going to be Delaware or Wyoming.
that makes sense. That makes sense. And something that I know you mentioned briefly was a Series 7 license based off of the level of the deal or the amount of the deal or the money that's even being raised.
Be
So
able to
I
raise, yeah, to be able to take a performance fee, you need a Series 7
okay.
for somebody who's not part of the deal team. So you do not need a securities license in order to do this. So syndicators, sponsors of their own deals do not need a securities license. They're essentially selling their own thing, which doesn't require a license.
Right. And now with that as well, I've heard about three different series license. So is there one that you would maybe lean towards more than the other, or is it just based off of what your end goal is?
It's totally end goal. I mean, a Series 7 is great because it's so broad, but it's the hardest test. It's tough. It's not an easy test.
Hmm.
The Series 22 is easier than the Series 7, but you can't sell other more public securities with it, or it's just more restrictions. Series 22 is really for selling alternative investments only. So it's fine, but if you need to do some of those other things, you're going to need a 7 anyway. Um, but for the vast majority of syndicators, they don't need a securities license. It actually becomes a little bit more trouble to have one than to. I had a Series 7 for a while and just shut it down because it was making my life harder rather than more helpful.
Wow. That's actually very interesting perspective. Now, what if it was like a Series 65 license? I haven't done too much due diligence, but I've seen that you can kind of say qualify as like a financial advisor.
Sure.
So would that be kind of beneficial for the actual syndicator to have the Series
Not
65
really.
license?
Not under most strategies. The what where it gives a slight advantage, and the structure changes pretty radically, is if they're basically are a registered investment advisor, they can take fees, right? They can charge their clients fees, but they can't take broker fees. So basically, the registered investment advisor can be the owner of that investment and then take fees like it's under management from the syndication, but they can't get paid like just a regular performance fee. It'll be like an annual fee.
Got it. That makes sense. That makes sense. So if you could also then look to tell, the listeners what was actually maybe one of the hardest deals you've come across that you've had to work through that you were like, this is pretty bad. Or this is not it has the potential to go really bad if this deal doesn't close.
Of mine or of someone else?
Ooh. I think both because I think that you've been on the end of both of them. You're like, "Ooh, this is my
Yeah.
deal." But the other deal is like, "Ooh, you got some work to do. This is your timeline. You got about 30 days." Like,
Yeah, not time pressure wise. I mean, I had a deal where it was just it just wasn't that good of a deal. And the only reason I did it was I had partners that wanted to do and were gung ho on it. And even still I shouldn't have done the deal. It didn't lose money, but it wasn't a great, certainly wasn't anything I liked or was happy with. And I left that deal right after it got bought because it just
yeah.
wasn't part of what I wanted.
Hmm.
And it was hard to raise money for. Oh my God, because how do you pitch something that you don't like at all? It probably was pretty evident I didn't like it.
Hmm.
Um, for clients, I mean, it's really the challenges that come up with clients is really the more complicated the deal gets, the harder it is. Like if there's way too complicated distribution structure, it just
Yeah.
starts getting investors start getting scared off. If it's I don't know, if they're trying to do something fancy like tie in a 1031 exchange as part of it,
Oh, wow.
it gets super complicated. And I wouldn't advise going down that road um, for a specific syndication. Um, when owning a building and doing a 1031 is great.
Hmm.
But
Yeah.
let's see what else has been. Um, yeah,
Like
I
the,
mean, time always gets kind of short in a deal,
okay.
and it's not anything to be afraid of. It's just you just have to know it's going to happen, that you're going to have at the end of the day, there's going to be a small amount of money many times that haven't sold, and you're going to be figuring out how to do it. And there's a lot of strategies. Most of it is giving up a little bit of the piece of your syndicator share um, in order to get the job done. But it's not going
Right.
to be enough. You're not giving away enough that you'll be mad at yourself for doing it. I mean, you're still going to make great money. You just might make slightly less than what you thought you were going to make.
Hmm. Would you say that what has been kind of like a reoccurring theme you've seen in people who actually do successful syndications?
Um, Theme would probably be they are willing to do the work that's necessary to raise the money. I mean, raising money isn't hard, but it is work. Um, on the internet and stuff, you see like, oh, all you have to do is put this ad up and you get all this millions of dollars. That's not true. So everybody who's like really good in syndicating, they are always willing to talk to people, talk to potential investors. That's what they are good at, is just being open and honest about here's the deal, here's what it is, and are willing to do the work. It's the people who think, well, I can just put an ad up that are or come up with well, what if I just pay my friend to find all the money and a performance fee? Those people tend to be less successful, uh,
Hmm.
just because kind of everything you need to put in some work in order to that
Right.
work out.
Right. To actually have some equity in the deal. And with that too, is there something that you've also seen that's kind of like you kind of tell some of your clients to be mindful of as they're putting the syndicate together? Like some advice?
Yeah, I mean, there's a lot of things that go on as we go. I mean, it's everything that I mean, my philosophy, really kind of boils down to on one hand, it's founder investment theory. On the other hand, it's, open honesty, transparency with investors. So it's always, disclose honest. That's the only way that anybody's going to possibly be successful, I think. And so not that any of my clients want to hide the ball or anything like that, but it's identifying, okay, this is when we have to tell them something, versus these are the things that aren't these little changes. Oh, we want to buy this property and we told you the mailboxes are on the left, now they're on the right. I mean, who cares about that? But
Hmm.
uh, okay, well, now we were raising 3 million, now we're raising 5 million. Even though it doesn't feel like that is super material, it's probably material enough that we need to have that communication. And so you can have that communication, we can be positive about it, but just needs to be straightforward. I mean,
Right. Right. No, I really do. I really do appreciate the perspective and the honesty too. So would you say kind of like it's getting into being more of a character thing? So like people's
Yeah,
characters is always being tested because they're in a world where you're literally raising money.
you are. I mean, it's interesting as a sponsor when you look at your bank account balance and you see, $5 million in there. It's certainly
Oh, I see.
a
I
good
see.
feeling, but it's not your money, right? So
It's not
it's,
your money. Would you, oh
I,
man, I think that's really good though. I think because would you say that money would expose who people really were the whole time?
I fortunately I haven't had any of my clients have any issues of it. Fortunately, I did have an issue of it, or not an issue, but I had a client who not related to syndication at all, but he had put money with a 1031 accommodator, and he had like $10 million in it with an accommodator, and the accommodator left town, and that money is gone. So that was a big issue.
Oh man,
So I mean, certainly that person couldn't take the hit of it. I don't know. I would hope that nobody would do such a thing, but now I've seen somebody who's done, absconded. Uh,
hmm.
it's there can be checks put in place to make sure that sort of thing doesn't happen, but
Sometimes,
no.
hey, yeah. First and foremost, or again, I do want to reiterate, thank you so much for your time and attention. And one of my like final questions is, what would be a piece of advice you would give to your younger self?
Well, starting the syndication world earlier, I didn't even know at the beginning that I would be doing a syndication to raise for that assisted living facility. So I didn't know where the money was going to come from. That was kind of part of the problem why I ended up in law school. Uh, so I probably would say, get started in the syndication world sooner. Um, but also just don't have as much fear about all these things. I mean, and people don't get mad about talking about investments and things like that. They almost everybody's quite pleasant in this world, and talking to potential investors is easy. I mean, you're trying to make
Hmm.
their lives better by giving them something that will make them money. That's one
Right,
of the nice things about syndicating is we're in the business of making people money. Uh,
right.
there's no downside to that. You may not get every investor, and you certainly won't. Um, but there's I've never had anybody yell at me or curse at me for, as a rejection. So there's really nothing to be afraid of in doing it. These deals just generally always work out. And if you're working with a good team and a good, attorney and everything, it can work out so that even the worst case scenario is really not bad at all. It isn't bad. It's just the deal doesn't happen to go through.
Right. I really do appreciate your honesty, your transparency, and the way that you were able to articulate the wisdom that you've gained over the years. I think it's something that is not only remarkable, but I think that a lot of people will gain a lot of value from this. Truly.
Cool. Well, thank you so much for having me on your show. I mean, it's a great podcast that's out there, and I
Thank
have
you.
billions of listeners.
Thank you. I'm hoping for the same thing. Thank you so much, Tilden. Truly.
Thank you. You bet.